Here's another face, an actual face I'd like to talk to. It's Tony Dwyer, Canaccord Genuity Chief Market Strategist.
You
Tony,
should really go to the metaverse.
no way. Tony, it's good to see you. Now, as we see what's going on today, what is the sort of takeaway? I know that you have been warning investors to brace for volatility. Here it is in spades. What's the sort of takeaway? I mean, this is not just an interest rate increase related fear for Facebook. This is real stuff.
Yep. It's the differentiation you get in the transition of an economic cycle. From where, remember, Julie, what happens is coming out of a recession, each recession is unique in the way that we get in there. It could be the pandemic. It could be the great financial crisis, 9/11, the savings and loan crisis in the early 90s when Saddam Hussein invaded Kuwait. Ultimately, the response is always the same, which is throw as much money at it as you can. And when you throw as much money at it as you can, all of that money has to get invested. And that money typically gets invested in financial assets as well as things like houses and stuff like that. So this is not unusual where you get this kind of differentiation. And it's going to continue. I know that there was another mega cap name yesterday that reported that did really well. And folks were like, okay, that one did really well, so these might do well. And that's not the way it worked out, because there is that differentiation at this point in the cycle.
Tony, if trades like Facebook and Netflix, they're not going to work, and they haven't worked. Meta getting creamed here. Netflix got creamed on its earnings. Where do you think investors should hide out?
Well, the problem, Brian, is that everybody thought that some of these mega cap, growth names were defensive, and it's not proving out that way. So unfortunately, the top five, according to Ned Davis, at the end of the year, the top 5 stocks in the S&P 500 accounted for about almost 30%, the better part of 30% of the index, which is historically the highest since the early 70s. So you're in the situation where a lot of folks went to these names thinking that they're defensive, and they're not. And what happened is you're seeing that money come out of them, which is probably exaggerating some of the moves. But again, as you guys know, I don't talk to specific stocks. I'll leave that to the analysts. But it really, again, this hits that whole tumultuous feel that we're going to have coming into this year. And guys, it's not so dissimilar to what happened in 2005 in the first half or 2011 in the first half.
I want to bring up central banks for just a minute, because we have a lot of news on that front today. The Bank of England raising rates 25 basis points. I just saw a headline that even though the ECB is not explicitly saying it is going to be raising rates necessarily, it is going to be winding down its bond buying program. There's a headline, it may be recalibrating, quote unquote, in March. We know what the Fed is doing. What does all of this do to investors' ability to find stuff that's going to be resistant in that rising rate environment?
Well, resistant to the initial impact psychologically, or the resistance to what it's actually going to mean toward their interest expense. So, Julie, I think it's really it still blows my mind when I say it out loud. We're talking about the Fed raising up to maybe 4 to 5 times this year, according to some, maybe even a 50 basis point, winding down the balance. They're still buying bonds. If they were that worried about inflation, why didn't they stop buying bonds at the January meeting? So they're still uber accommodative. That's where I differentiate a little bit. I think the Fed is going to lower fewer times than the worst case scenario. But I think that this whole the Fed fear and the economic transition I talked about from doing stuff because we were given so much money and we're sitting at home to buying stuff to doing stuff. I think that's going to be a really important and strange, tumultuous time in the first half. But this whole idea that the Fed is going to be extra and excessively tight, I think sets the stage for the recovery toward the second half.
So it sounds like, to boil all that down, you think the market is too hawkish here when it comes to what it's expecting, not just how many times it's expecting the Fed to hike, but the effect that is going to have on stocks and on the real economy for that matter. Am I extrapolating too much there, Tony?
Well, Julie, as you know, when I say I think or I believe you should run the other way, I go by the data. And I got the 10-year inflation break-evens, which, as I look over, are 2.42%. They've actually come down a little bit, I think, in the month of January. So the long-term inflation break-evens, the 10-year note yielded at 1.8%. tells me if you think the Fed is going to 2.5%, you better bet on much higher long-term interest rates, which aren't happening. So the way the inflation break evens and the long-term interest rates, they're suggesting the market believes, or real investors believe, that the Fed will be successful in transitioning from this high inflation environment back to a more normalized environment. And again, that should happen as we get into the second half. There has been a historic rise in wholesale inventories. And when you have a supply chain constraint, what companies and households do is if you want 10 widgets, you buy 20. You order 20. Well, the wholesale inventories are led by goods orders by 5 months. Goods orders are coming down dramatically, which suggests you're going to start depleting those inventories over coming months, which means you're going to be producing less goods. That's that weird transition where we're going to have a Fed in a box that's going to be raising rates beginning in March. Dot plot says 3 times. But you're going to be doing that at the same time as getting this economic transition from buying stuff to doing stuff. So it's going to feel soft and squishy. So it's just going to be it just makes for a very difficult investment environment in the first half.
In the second half, Tony, do you think the market is set up to rally into your end and the ground is set for another year of double-digit returns? Not like we saw last year, but could we see the S&P 500 and the year up 10%?
I don't think we'll see it that much. On December 6th, when we put out our 2022 outlook, we called it a plus or minus year. Brian, it should. So let's go to the data. Since 1980, when you've had the S&P 500 up more than 25% in a calendar year, the next year has a median gain of 13% with only 2 negative occurrences. So history certainly suggests that you're going to have a positive year. There are a few instances of less than a double-digit percent, and I think that's likely to be the case. But we have to see what the Fed is doing going into year. If the Fed is super aggressive and the 10-year continues to stay low and even come down further, you're going to be darn close to an inversion, which isn't great. Doesn't mean the market or the economy goes negative right away, but it's definitely going to be a heads up. And so,
finally, what do you do strategy-wise here? I mean, if we are seeing this sort of differentiation within sectors, can you employ a sector approach, or do you just have to be a stock picker here?
Julia, it's really risk on or risk off. I was talking to a healthcare executive earlier today. I don't know, is healthcare defensive or offensive? You've got pharmaceuticals, which are defensive. You've got biotech and med products, which are offensive. So I think in this environment, in the first half, and it's proven to be true, I think we want to avoid a catastrophic mistake versus making a bet. And by avoiding a catastrophic mistake, you don't sell into the kind of sentiment we had early last week. Right. And you don't feed into an 8% rally off the intraday low in 3 days. It's just avoiding getting too negative when it's down or too positive when it's up. It's going to be this kind of tumultuous volatility around Fed policy and economic transition.
Steadiness should rule the day, it sounds like. Tony, thank you. Good to see you. Tony Dwyer, Canaccord Genuity Chief Market Strategist. Appreciate it.